Well, moving to the bond market, and Jonathan Sheridan from FIIG Securities joins us live now for a look ahead to this evening. It's going to be a big overnight session on Wall Street, Jonathan. No doubt fixed income investors will also be keeping a close eye on what comes out in terms of these non-farm payrolls. Just tell us how significant they are and what you'll be watching specifically.
Yeah, good afternoon. Look, the non-farm payrolls number is probably the key employment statistic that comes out of the US. They also release their unemployment rate. It's just the bellwether at the moment for the US economic recovery. So bond investors in particular will use it as a guide as to whether there's any kind of indication whether the Fed will look to change their tapering program, and therefore that'll have an impact on bond yields. So a key piece of data, and I'm sure will affect equity markets as well.
Let's also talk about the other news out from the central bank there, which is the resignation from one of the Fed members. And this member was also the lone dissenter when it came to the likes of credit bubbles. So what is this likely to mean?
Well, I think when anyone of the stature of any of the Fed board members resigns, there's obviously people, take a look at the reasons behind it. He said he's going back to teach economics at Harvard. I think if you're an academic, that's not a bad job to have. But obviously he, as I said, was one of the lone dissenters on the Fed board, if you like, about the possibility of the US entering a credit bubble. The easy money that's around has pushed riskier assets to almost record prices, and in particular he mentioned the high yield bond market. So investors searching for yield, buying weaker credits to chase that yield, and he was concerned about their prices getting into bubble territory. Other things that we're seeing as a result of that easy monetary policy are the margin debt, as reported by brokers on the New York Stock Exchange, is at record highs ever. 2.73% of US GDP, about $465 billion US dollars. So what that really means as a risk factor for equity markets in particular is that if there is a correction, it'll be made all the worse by all the margin calls that'll be coming through, and then there'll be forced sellers.
Yeah, and this is, just to finish off, one of the fixed income stories this week that certainly caught my eye and yours, it would seem, and that was that Greece is going to issue some new government debt. Now, you said you weren't sure if this one was an April Fool's joke. What do you think?
Yeah, that's right. Look, that came out on the 1st of April. I had to wait a couple of days just to see if it was real or not. I think, it's been widely reported now, so I think we can take it as a fair indication that it will happen. I mentioned a couple of weeks ago that the yields on existing Greek government debt have come down below 7%, so they obviously see that as a bit of a hurdle rate where they can actually go to market and have their bonds bought. That's always the first task for any person or institution issuing debt, is to sell them. They obviously think that 7% level's a hurdle rate, and good luck to them. I hope they do get their finances sorted, because those peripheral nations are key to the Eurozone recovery.
All right, Jonathan Sheridan, thanks so much. Really appreciate that one.
Great, thanks very much.
All right, wrapping up, an update from the fixed income space.